Welcome to Investors Insights. Our topic, walking tall at the Fed. I think you're going to enjoy this today. We're going to talk about the height chart. We're going to talk about AI bubble, question mark. We're going to talk about economic news and data coming out. And we're going to address some things that may be concerning you. But with that, I want to introduce my distinguished colleagues, Trey Booth, Bobby Norman, and Ty Miller. I always enjoy my Monday morning meetings with these guys because throughout last week, over the weekend, and even early this morning, they were gathering data and research that we'll use in our portfolio strategies in conjunction with our clients' financial blueprints. So with that said, Trey, I want to start with you. And the reason I do, you brought out some great facts here because last week, the Fed was a hot topic in terms of interest rates, as well as possible new Fed chairman. So talk to us about that.
Yeah, thanks, Greg. Yeah, so the Federal Reserve met last week and announced, in really a lightly covered meeting that they're going to take no action on interest rates. And it really wasn't heavily covered, and the markets really didn't react because it was widely expected. So no real news came out of the Fed, and the good news, and that's because there's really no need to cut interest rates. The long-term rates have remained stable. Short-term rates came down as the Fed cut. We haven't seen an economic weakening. The economy still seems to be on the same pace it was in the year. So it makes sense to sit back and watch and see what the data comes. And so the Fed will have two more meetings until May. So that's pretty much Jerome Powell has two meetings remaining. And I think markets right now are pricing in. He probably won't do anything in the next two meetings because the big news around the Fed really didn't have to do with interest rates this time. It came on Friday when President Trump announced who he'll be nominating to the new Fed chair. And that will be Kevin Warsh. Now, who's Kevin Warsh? He's a well-respected economist who's actually been on the Fed board of governors before back in 2006, when I think he was the youngest Fed board member ever at the age of 36 at that time. So he's widely respected and widely known, and his opinions on economic policy are really public because when you're on the Fed governor's board, what you say makes news. And so the markets reacted quickly with that announcement. We saw interest rates go up. We saw, Bob was going to talk about the AI bubble, but temporarily the precious metals bubble seemed to have popped. We saw silver rates. We saw the price of silver drop almost 20% on the announcement because there's perception that Kevin Warsh is not an easy money Fed chairperson. He's a hard money or what is considered a hawk Fed chairperson. So really focus on bringing inflation down. So that's not what President Trump, is perceived to want, which is lower interest rates. So he put someone into place of the people that are considered maybe the most hawkish. But what confused me is why would people be surprised while our interest rates are going? Because we've shown this chart before. This chart shows the height of the chairman of the Federal Reserve over time. And this pretty much lines up with where interest rates are going. So you can see here, way back in the 70s and 80s, we had Paul Volcker. He was 6 foot 7 feet tall. We had high interest rates. Then came in Alan Greenspan. He was respectable 6 feet tall. So the interest rates came down to 5, 6 range. And then Ben Bernanke came in at just under 5'8" interest rates came down. Then we had zero interest rate policy under Janet Yellen at 5'3". Then Powell comes in, spikes interest rates back up to 6 feet, and we've got Kevin Warsh is pretty much in line with Jerome Powell. So if you wanted lower interest rates, we really needed to see a much shorter individual at the Fed, at the chairman of the Fed. I mean, it's pretty much lockstep. So based on this model, we expect interest rates to roughly remain where they've been. And so something we're watching kind of tongue-in-cheek, obviously, that's correlation without causation right there, but still an interesting chart to look at.
Yeah, well, when you showed the chart this morning, I was in the floor because, I remember the days when they would judge Greenspan in his decision-making on how fat his briefcase was as he walked across the street to the Fed meetings. Trey, you may be onto something. And so we'll have to take that in consideration. But folks, you've heard it here. Height may matter. Walking tall at the Fed is why we chose the topic. And we're going to look at every kind of data we can to understand what we're looking at down the road in this journey of interest rates and the changing of the Fed chairperson. With that said, Bobby, you've really dived into AI, and I appreciate that. I know our clients do as well. And the AI bubble, there's been a big rumor or media has been picking up on different topics. Some of our data is not showing that. And I think, you made some really strong points this morning in our meeting. So talk about it.
Yeah, so last week we saw one of the large tech companies trade back over 10% in one day, which had the market spooked and the talk of an AI bubble going around. So I want to cover why the AI bubble talk is overdone, especially with the comparisons to the dot-com crash days in the early 2000s. So I want to show two charts to explain why a market comparison to the year 2000 isn't an appropriate analogy. So the first chart shows that during the dot-com era, which is 1998 through 2001, stock price growth seen in the green line significantly outpaced forward earnings seen in the blue line at the bottom there. And the circled area in the chart here highlights that stock prices reached levels that were way above reasonable valuations based on earnings. And the reason why we're not seeing the irrational exuberance today, like we saw in the dot-com era, can be seen in the next chart that covers the AI era, which is 2020 through today. So unlike the dot-com era, stock prices have been moving up with the forward earnings, and the current valuations are justified by the current earnings growth seen in the chart. As always, no guarantees, but the talk of an AI bubble shouldn't spook investors based on one company's stock price trading down for one day. And instead, we think long-term investors should focus more on earnings growth and the fundamentals.
Yeah, and we need to stay focused on that. There will always be emotional moments in the market, but you have to remain calm. So, yeah, I thought that was a great summary, and I thoroughly enjoyed your charts. And then, Ty, everybody who knows me knows I'm really a nerd. There was a time in my life I had the glasses with the tape on them and the pocket protector with all the pins. And, you know, through counseling and everything, I'm now down to about 4 pins here in my coat pocket. But one thing I thoroughly enjoy is when you go into the economics and the economic data, you allow me to nerd out. And I thank you this morning for the data that you brought forward. So here we are. We've talked about the height of the Fed chairman. We have talked about AI, but let's get back to economy and what we're seeing here. Tell us some of your research and data that you brought in this morning's meeting.
Yeah, well, first, I think everyone would enjoy if you brought back the glasses with the tape. I think that would be nice to see.
I had to give them up. Peggy wouldn't date me.
But as far as the economy goes, the economy's it feels pretty strong. U.S. productivity is something that we've kind of been harping on for a while and something that we've wanted to see. And to Bobby's point with AI, it seems like AI is starting to take shape on productivity. So Q3, which is the last reported quarter for U.S. productivity, was nearly 5%, coming off of another strong, 4% number in the previous quarter. So productivity is really starting to take shape here. And what's going to be interesting to see is how that, compares to inflation. We always have these inflation concerns, something the Fed's been worried about. Oil prices are starting to climb, which, if that is a sustainable, kind of move, that could be something that threatens a pop in an inflation number. But interestingly enough, what is help keep inflation down, restrain, labor costs, is also why maybe the economy doesn't feel as strong as it actually is. Wages last year were pretty flat, and on the consumer, with you still have 2 to 3% inflation, that can feel a little pressing coming off of the big inflation spike we had in 2021, 2022, and so. That's interesting to see of how we're, maneuvering things. Overall, we think, productivity has been very strong. We want to see that continue. We think AI can help that. And then inflation, we believe, is anchored right now, mainly because there's not a lot of new money being printed. We've used the example before that, if you have $10 in an economy and 10 apples, each apple costs $1. And then if you print more money and you have $15, but still 10 apples, then each apple costs $1.50. But interestingly enough, we might be trying to get to a point where inflation is low. Maybe we still have those $10 or $11, but maybe with AI and this productivity enhancement, we can produce 11 or 12 apples. So that's going to be interesting to see as we continue on this journey of productivity versus inflation.
Yeah, and you make a great point there. These are dynamic times. And in dynamic times, you'll have positive news and you'll have negative news. And we got a lot coming at us in all directions. But with that said, is that in my 44, now 45 years of being in this industry and going through economic cycles and market cycles, the beauty of this country is innovation, the way things can evolve. I never dreamed we would have some of the career paths we have today that didn't exist, 15 years ago. There's opportunities out there, and we're always looking for the opportunities, as well as those trends of industries that may start to fade. But regardless, we're going to navigate through it. We're going to do this kind of research, and we're going to keep our clients updated. And so I hope you thoroughly enjoyed this vlog. I hope you share it with others, your friends, your family, your colleagues. And just know that every day here at Five Plan Partners, we walk in this building striving to see to it that our clients' lives are better, richer, fuller. Go have a great first of the month, February, and just know that we're celebrating you here at Five Plan Partners. Thanks.